Welcome to Breaking News to Trading Moves. I mean, imagine waiting 38 years just to break even on a business investment. Sounds crazy, right?
Yeah, completely unhinged.
Well, mathematically, that is exactly what millions of passive investors are doing right now. So, the headline today. The S&P 500 index recently experienced a 17% upward climb amidst a macroeconomic environment where the Shiller PE ratio sits over 40. The clear winners right now are momentum traders and mega cap tech companies, like Apple, AAPL, Microsoft, MSFT, and NVIDIA, NVDA.
Right, and the losers are strict valuation adherents, and, well, those caught holding the bag when market corrections occur.
Exactly. We are here to debate a central question regarding this environment. Is the traditional buy and hold passive index strategy a reliable mechanism for building wealth? Or is it a structural trap that guarantees poor outcomes in overvalued markets?
And we have two very different takes on this.
For sure. I represent the view that steadfast endurance through passive investing remains the most reliable path, basically because human psychology is our absolute greatest liability.
And I represent the contrasting perspective. Active, valuation-based discipline is essential to preserve capital. Passive index investing is, well, mathematically flawed and increasingly dangerous in our current macroeconomic environment.
Let me start by outlining why human behavior makes passive investing an absolute necessity. I mean, human nature is structurally warped against sound investing.
Right, we are our own worst enemies.
We really are. Howard Marks often describes this through the nonlinear utility function. And let me translate that. In plain English, that just means a loss hurts you twice as much as a gain feels good.
Loss aversion, basically.
Exactly. Loss aversion. And when you combine that with recency bias, it guarantees that ordinary participants invariably buy high when euphoria takes over, and then they panic sell when prices cascade downward.
Even when they know better.
Yes, exactly. Research clearly shows that attempts to overcome these irrational tendencies through education alone are entirely futile. We know we should not panic sell, yet we do it anyway.
So your solution is to just take the human out of the loop entirely.
That is the only effective countermeasure. Automation. A passive, automated buy and hold strategy eliminates human error. It removes the capacity for self-sabotage, allowing an investor to simply endure the volatility. You capture the long-term economic growth of the broader market without your own brain getting in the way.
I come at it from a completely different angle. The premise of passive investing relies on an underlying mathematical mechanism that is inherently flawed. Specifically, capitalization-weighted indexing.
Okay, walk me through the flaw there.
Well, in a cap-weighted index, when a stock price rises, the index mechanically buys more of it. You are mathematically forced to buy the most expensive items on the shelf simply because they are popular.
But that is just how the market values them, right?
Sure, but let us look at that Shiller PE ratio over 40 that you mentioned at the top of the show. To put that simply, it looks at average earnings over the past decade. A ratio over 40 means investors are paying 40 times those earnings.
Right, so they're waiting nearly 4 decades just to get their money back based on current corporate profits.
Exactly. We are looking at a 2.6% earnings yield. That is compared to a much higher risk-free yield on U.S. Treasury bonds. The current mechanism blindly forces capital into a highly concentrated handful of companies.
And you think that concentration requires active management to fix?
I do. It demands active intervention. You have to rely on economic scale or strict swing trading rules to protect capital against severe, prolonged drawdowns.
Okay, before we go further, clarify this for me. Are you saying the index is literally forced to buy stocks just because they are expensive?
Yes, absolutely. Because the index weights holdings by market capitalization. As a company's stock price goes up, its market cap grows.
Right, so it automatically takes up a larger slice of the pie.
Exactly. The index must allocate a larger percentage of every incoming dollar to that specific stock. And that happens regardless of whether the underlying business metrics justify the price.
I mean, I see why you argue that, but let me give you a different perspective on the mechanics of capitalization weighting. You characterize it as buying the most expensive items on the shelf. Let us look at it through a grocery store analogy.
Okay, I'm listening.
Imagine a shopper who actively tries to predict which aisle will have a sale. They run from the dairy section to the bakery, trying to time their purchases based on pricing signals.
Which sounds exhausting.
It is, and invariably, they miss the sale. They end up paying premium prices anyway due to the fear of missing out, or FOMO. Buying the cap-weighted index is like simply placing a steady, automated order for the entire store.
But you are still buying the overpriced items.
Yes, you buy the premium items, but you also automatically acquire the discounted ones. And you do it without having to rely on human discipline to make the choice. Active alternatives rely on an individual executing a strategy perfectly over decades.
And you are saying humans just cannot do that?
The data shows that human discipline always falters. Eventually, someone panics or gets greedy.
Wait, let me stop you right there. I completely understand the grocery store comparison, but I just do not buy that it applies here. Let me tell you why.
Go ahead.
Your analogy assumes the store's inventory remains relatively balanced over time. In reality, passive cap weighting entirely removes price discovery from the equation.
How so?
Let us look at a historical example. In early 2000, technology and telecom stocks rose so aggressively they consumed 45% of the market capitalization, but they only represented 15% of the actual economy measured by sales and cash flow.
Right, the dot-com bubble?
Exactly. The index mechanically held its absolute maximum exposure to tech right before the crash. Conversely, in 2009, indiscriminate selling drove heavily discounted value stocks down to minimal weighting.
So it held the least amount at the worst possible time, in your view?
Yes, it forced passive investors to hold their lowest exposure right before those sectors rebounded. You are blindly buying a bubble and mechanically selling the bottom. It is the exact opposite of buying a balanced grocery store.
That is a valid concern, I will admit. Though I would frame it differently. The structural flaws of cap weighting, such as the massive concentration in Apple, AAPL, and Microsoft MSFT right now, are secondary to the primary threat.
Which you believe is psychology.
Psychology, yes, but also institutional constraints and behavioral traps. If you abandon the index for a valuation-based active strategy, you rely on managers who are incentivized to avoid career-ending losses rather than maximize your gains.
Career risk is a real factor, sure.
David Swensen famously pointed out that succeeding in investment management requires non-institutional behavior from institutions. An active manager who refuses to buy tech in a bubble gets fired for underperforming the benchmark.
They lose their job long before the bubble pops.
Exactly. The passive index, for all its concentration, at least removes that agency problem and the emotional panic. You own the market, flaws and all, but you guarantee you will not underperform it.
But owning the market, flaws and all, assumes the market is a stable entity over your lifetime. We must look at the physical reality of the companies inside the index, and we have to look at the demographics of the people holding the funds.
What do you mean by demographics in this context?
Well, corporate lifespans are shrinking rapidly. In 1970, the average tenure of a company in the S&P 500 was 35 years. Projections show it falling below 15 years now.
Right. Companies do not last as long.
Exactly. You are buying and holding a static vehicle whose underlying components are dying much faster.
Hold on. Why does that make the vehicle static?
Because you are assuming the index will always perfectly capture the broader economy. Combine that shrinking corporate fragility with the demographic reality of 75 million baby boomers preparing to sell their exchange-traded funds.
Oh, to generate retirement income.
Precisely. If you are listening to this and you automatically put 10% of your paycheck into an S&P 500 ETF every 2 weeks, you might be thinking this does not apply to you.
But they are sharing the same vehicle.
Yes. When a huge generation of retirees needs cash, the ETF manager is structurally required to liquidate the underlying shares. They do this regardless of business health. This creates a mechanical downward spiral where funds must sell shares simply to meet redemption requests. The passive flow reverses.
I am really not convinced by that line of reasoning. The corporate turnover you just described is exactly why the index works.
How is a dying company a feature?
Because it is an automatic self-cleansing mechanism. When a corporation's lifespan ends and it falls out of the top 500, the index automatically purges it.
But you lose the capital that was invested in it on the way down.
Sure, but at the exact same time, it absorbs new innovators without requiring the investor to manually identify the next technological leader. You do not have to predict when companies like Palantir, PLTR, or Advanced Micro Devices, AMD, will command larger market shares.
The index just buys them as they get bigger.
Exactly. It naturally allocates capital to them as they grow. The mechanism cleanses the failures and captures the innovators seamlessly. Attempting to actively front-run demographic selling pressure requires precise market timing.
And you think that is impossible?
I think it brings us right back to those destructive behavioral traps we discussed earlier.
Well, that self-cleansing mechanism sounds great if you have 40 years to wait. But what happens when you do not?
You mean for retirees?
Yes. What happens when you actually need to retire and pull that money out? This brings us to the mathematical peril that active strategies attempt to solve. We are talking about sequence of returns risk.
Right, the timing of your withdrawals.
Exactly. If you are accumulating assets over 30 years, early volatility matters very little. But the transition from accumulation to distribution changes the math entirely. The data is remarkably clear here.
Go on.
When we run thousands of computer models of the stock market, often called Monte Carlo simulations, they show something alarming. They demonstrate that the compounded return over the first 10 years of retirement explains 77% of a retiree's final financial outcome.
Explain how that plays out in a real scenario for our listeners.
Let us look at the lost decade. Think about this for a second. From 1999 to 2009, the S&P 500 compounded at a mere 1.0% annually.
An entire decade where your money essentially did nothing.
Exactly. If you retired in 1999, you did not just lose money, you lost your most valuable asset, which is time. If you face a lost decade and you are forced to sell shares at depressed prices to fund your living expenses, you suffer permanent capital loss.
You lock in the depletion of your share count.
Yes, making recovery completely impossible. This is why the safe withdrawal rate, the percentage of your nest egg you can spend each year without going broke, is currently modeled at a mere 3.9%. Blind accumulation into a volatile index is dangerous when you actually need the capital to survive.
I completely acknowledge the mathematical reality of sequence of returns risk, and I agree, a lost decade is a terrifying prospect for a retiree.
It ruins retirement plans completely.
It does. But your solution, stepping out of the market or actively timing valuations, introduces a far greater risk.
How is protecting your money a greater risk?
Because if you use a moving average rule or a valuation metric to step out of the market to avoid a drawdown, you almost certainly miss the highly concentrated days of recovery.
Missing a few days cannot be worse than a decade of zero growth.
Historically, it actually is. Missing just the 10 best days in a decade devastates long-term compounded returns. The market does not give you a polite warning before it surges 5% in a single afternoon.
That is true. The best days often follow the worst days.
Exactly. Warren Buffett framed this beautifully. He states he prefers a lumpy 15% return to a smooth 12%. The investment industry constantly conflates price volatility on a screen with true risk.
Well, volatility sure feels like risk when you are living on the money.
It feels like it, yes. But true risk is not the temporary fluctuation of prices. True risk is the permanent loss of capital that occurs when an investor abandons their strategy in fear. Steadfast endurance allows the investor to capture the full recovery.
But active timing, you are saying, demands too much precision.
Exactly. Active timing requires you to be right twice. You have to know exactly when to exit, and then you have to know exactly when to re-enter.
That is a compelling argument, but valuation discipline is not about jumping in and out of the market based on fear. It is a thermostat.
A thermostat? Tell me more about that.
You are not trying to guess the weather outside. You are mechanically turning off the heat when the room gets too hot. Meaning, you stop buying when multiples exceed historical reality.
So it is still an automated process, in your view?
Yes. You rebalance the portfolio based on actual economic scale, tangible metrics like sales, cash flow, and dividends, rather than treating the index like a popularity contest. You demand a margin of safety.
But you are still deviating from the market consensus.
Because the consensus is often wrong, you refuse to pay inflated multiples for businesses. This immunizes you against the corrosive effect of being overweight in overpriced technology stocks. By untethering your capital from market momentum, you protect the absolute value of your portfolio precisely when you need to draw from it.
The challenge with applying a valuation thermostat in today's public markets is that it might keep you out of the room entirely for over a decade.
That is a fair point. Valuations have stayed high for a long time.
Right. And we are seeing capital actively seek alternatives precisely because public markets are concentrated and volatile. Let us look at where sophisticated capital is moving.
Exactly, and we should talk about why that capital is moving. Real value creation has completely abandoned the public indices. Let me give you the numbers and then explain the mechanism.
Go ahead.
In 2021, private markets raised $1.73 trillion in committed funds. Now compare that to the $434.7 billion in new stock issuances from public companies. The discrepancy is stark.
So the companies driving the actual economy are staying private much longer.
Yes, exactly. Why? Because mega funds in venture capital, private equity, and private credit can now write $100 million checks behind closed doors. A company no longer needs to ring the bell at the stock exchange to raise capital for growth.
They just go to private credit instead.
Precisely. They generate their explosive growth in the private sector, and by the time they finally go public, the massive gains have already been extracted by institutional elites. The retail traders passively buying public market indices are merely left with the scraps, like mature, slow-growth companies.
So you're saying the public markets are just a dumping ground for mature companies?
Yes. The public markets have become a concentrated arena of mega-cap technology firms, while the actual yield and growth exist in the private sector.
That is an observation I must challenge vigorously. You are portraying the private markets as an arena of superior value creation. But they do not avoid volatility. They merely obscure it.
Obscure it? How do you mean?
Let us examine the private credit space, which has grown to $1.6 trillion in assets under management. It provides roughly 7% of all credit to non-financial corporations.
Right, it is a massive sector now.
It is. The average loan size exceeds $80 million, rivaling regulated banking institutions. However, we have to look at how these loans actually function. These private loans operate entirely in the dark.
They are less regulated, yes. They lack the traditional banking covenants, the safety nets, and the rigorous regulatory scrutiny required in public markets. Asset managers originate these loans, collect the upfront fees, and then use securitization to bundle and pass the risk onto institutional investors and pension funds.
So you think there's hidden risk there?
Absolutely. We are looking at a space heavily reliant on unseen leverage and floating interest rates. And importantly, it has never been tested in a severe, prolonged economic downturn. Public markets, for all their lumpiness and daily price fluctuations, offer total transparency.
Transparency does not prevent a 50% drawdown, though.
True, but they offer immediate price discovery and instant liquidity. If an asset is failing, the public market tells you the truth instantly. Private markets let you pretend everything is fine until the entire structure collapses.
Well, they offer liquidity, yes, but at highly distorted valuations dictated by the mechanical flows of passive funds.
You mean because of the index funds buying indiscriminately?
Exactly. If the public markets are structurally overvalued and concentrated, and the private markets are opaque and carrying unmeasured leverage, then systemic dangers surround the investor everywhere.
Which is a grim picture.
It is. But it forces our discussion back to the practical necessity of capital preservation. You cannot blindly trust an autopilot system that lacks the sensors to detect the storm ahead.
Even if the autopilot is mathematically guaranteed to capture the recovery.
Recovery does not matter if you go broke waiting for it. When passive mechanisms force capital into the most overvalued companies at the exact moment they are most vulnerable to a crash, the only logical response is active, valuation-based discipline. You have to know what you are buying.
Yes. You must analyze the underlying business and refuse to participate in the most flawed elements of the capitalization-weighted structure.
Okay, to summarize my position in light of our discussion today, I concede that the public market is heavily concentrated, and I agree that capitalization weighting carries structural mathematical flaws.
Right. The concentration risk is undeniable.
It is. However, the behavioral traps of active management, the fear, the greed, the recency bias, and the institutional constraints, those are demonstrably more destructive to wealth creation than the flaws of the index itself.
But applying discipline mitigates those traps. I argue that trying to operate your valuation thermostat requires flawless human discipline in the face of mass panic, and history proves that is nearly impossible for the average participant. The moment you start trying to outsmart the mechanics, you fall prey to your own psychology. Therefore, steadfast endurance of public market volatility remains the most robust, reliable path to capturing economic growth.
And to summarize my stance, passive accumulation relies on a theoretical continuity that ignores the realities of corporate decay, demographic withdrawal pressures, and sequence of returns risk.
So autopilot is dangerous.
Exactly. Blind momentum is perilous. The mechanical nature of the index forces investors to buy the top of the market and sell the bottom. Therefore, preserving capital over a lifetime requires the courage to step away from the herd.
You need a margin of safety.
Always demand a margin of safety. Apply strict valuation-based discipline rather than mindless accumulation.
While we certainly find shared ground in the assessment of the current macroeconomic environment, the mechanics of the system heavily favor existing asset owners.
Very much so.
And we agree that blind euphoria is always a peril for the unprepared participant.
Absolutely. The tension between rigid mathematical valuation and the unpredictable reality of human behavior requires careful, ongoing navigation.
We leave it to the listener to weigh the evidence and determine their own approach. You must decide whether to trust the autopilot through the turbulence or take the controls and navigate the storm yourself.
It is a choice every investor has to make.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Tickers mentioned include AAPL, MSFT, NVDA, PLTR, AMD,